Okay, now we're going to go ahead with the Chapter 10 notes. So we're back at page 1 and we're at Part A. So, cost elements that go into property, plant, and equipment. What gets put into the T account? So, some of it's a review of what you already know. And the key thing here that's a review is it's the cost of getting the asset to you and getting it ready to use. So you did that in intro. For example, if you're bringing some piece of equipment to use in your factory, the cost of the shipping to get it to your factory, obviously the cost of the equipment, the cost of setting up, the cost of running an installation run, and then there could be other costs depending on what they are. For example, let's say it needed a higher voltage of electricity, so you had to get a new plug put in. That is the cost of getting it ready. Can't use it without that. Okay? So it would go in the T account. But what if you hit it with a forklift by accident? Is the cost of fixing that part of the asset? No, that's a repair expense because it's not part of setting the asset, sorting the asset to us and getting it ready to use. Okay, so that's one of the main ideas behind it. Now, we're going to take it a little bit further. So, with assets, both IFRS and ASPE require what's called componentization or bifurcating, which is splitting something up. For example, if you have a single asset like a building, the roof should be recognized separately if it's a significant portion of the asset's total cost and it has a different useful life. So in the past, we would just do the whole building all together. But over time, they started realizing, you know what, we could be a little bit more accurate by breaking it into pieces. Okay, like the HVAC system is usually a separate piece. A building could last for 30 years. You got to do the roof every, I don't know how. And maybe the HVAC system every 10 years you have to overhaul it or something. Okay? I guess 10 years would be a little short. Okay. So that will happen. Capitalized cost of property, plant, and equipment includes all expenditures needed to acquire the asset, freight in, cost to get it ready, and discharge obligations, which are dismantling, removing, and restoring, associated with the asset's eventual disposal, so site restoration. So you buy a gas station, or split one or the other, all the costs to acquire it, set it up, get it ready to use, and then you have to add on the cost of what it's going to cost you to restore that land once you're done with it. So you've got to add that in. Note GST, not included in the cost because it's a recoverable input tax credit, so you get it back as a business. Now, under IFRS, avoidable borrowing costs are capitalized, so put into the T account for PPE. And avoidable borrowing costs are if you didn't do the project, you could avoid the cost. So that's what they mean by avoidable. If you didn't do what you're doing, can you not borrow money? Under ASPE, there's a choice. You can either expense it or capitalize it. So one thing you do have to review, we did a little bit about it when we did purchases, but review cash discounts, deferred payment terms, and lump sum purchases on your own. Okay? Now, under IFRS, legal and constructive obligations, obligations that arise out of conduct and intent. So legal, it would be in the laws if you have to or sites where you've been selling gasoline. Okay, that's legal. Constructive obligations aren't necessarily, well, they won't have a legal rule forcing you to do anything. Rather, it's more like it's expected, so everybody in the industry would do it, so would you. Okay? Trying to think of one, because we've put so much stuff in legal precedent now that it's not necessarily constructive anymore. Let's say, even though it wasn't in the laws, if you build a business, there's an obligation to make sure you've got so much lawn so that it's green rather than just cement, that kind of thing. And if everybody's doing that, or if it's in a certain style, you'll do the same thing. Okay? So this one specifically is talking about restoring the land to the original state. A lot of it now is legal, not constructive, as environmental regulations have gotten more stringent. Okay, so do this. You can look at this, and then again, you did all of that in intro. It should come back pretty quickly. Okay, page 2. Now, non-monetary exchanges of property, plant, and equipment. That's key. We've done monetary in intro, and our example was monetary. So, under IFRS, when a company acquires an asset in exchange for shares, the asset is measured at the fair value of the asset acquired. But if you can't obtain and the shares are actively trading, then the fair value of the asset would be determined by the value of shares on the date of the exchange. Okay? So if you get equipment, some of your shares as payment. If they're fair value of the equipment, okay, like it's just regular equipment's being sold the same everywhere, you can probably estimate the fair value fairly accurately. However, let's say you've got a unique piece of equipment. Really only 2 companies use it, that kind of thing. It's harder to find the fair value. In that case, if your shares are actively trading, you could use the shares. ASPE is more flexible. Either measure is appropriate. So that was just a little reminder about shares in exchange. Okay, when PPE is sold, and it's not personal protective equipment, we're talking property, plant, and equipment. And monetary, remember monetary for 2, so cash, AR, NR, are received in exchange, then we just record gains and losses, just like we did on the first example on page 10. So this is the example on pen. So you did that in intro, we just refreshed your memory, that's great. Now in this course, so monetary gains and losses are recognized, everything's good. However, we run into some question about non-monetary assets are exchanged for a combination of monetary and non-monetary assets. So we might exchange one piece of equipment for some computers. So inventory, PPE, equity investments in other corporations. Now, if this happens, so non-monetary for a combination, monetary, some non-monetary. If the amount of monetary assets exchanged is minor, so that means cash, AR, and NR are small amounts. And we'll talk about that when we do some examples. Then the questions arise. At what cost do we record the new monetary asset? And should we record a gain or a loss on the non-monetary asset given up? So generally, non-monetary transactions are accounted for on the same basis as monetary. The costs is determined by the fair value of the assets given up, like we did on the other page, unless the fair value of the asset received can be more reliably measured. So we're giving up an asset, we're getting different assets. Generally, it's what you gave up that counts, just like we here on page 10. Fair value of assets given up. That becomes our new asset price. But let's say it wasn't cash or notes we're giving up, but I don't know, some other equipment or old machinery or something. If it isn't reliably measured, you could use the old machinery if you could figure out the fair value. Okay? So, this condition holds unless the transaction lacks commercial substance. So, commercial substance means there's a significant change in or a change in the configuration of the company's expected future cash flows. Okay? Or a specific part of the entity will change. So what we're talking about is something will change the efficiency we work at, our company works at, or the future cash flows will be changed. Changed or configured differently. Okay? Or, and this is or, only at one, fair values are not reliably measurable. Okay? So you have a non-monetary transaction. So non-mon. It's either going to be treated the same as monetary, or if it's lacking in commercial substance, or no reliable fair values, then it goes down here. Okay? So, if it does not have commercial substance or fair value measurements aren't available, then don't use the fair value standard. Instead, the cost of the assets received equals the carrying value of the assets given up. So here, back on page 10, we made this based on the fair value of the assets given up. If this would have been a non-monetary transaction with no commercial substance, this would have to be based on the carrying value of the assets, not the fair value. Okay? We're going to do questions. So it's carrying value, not fair value. That's the fair value standard. No gain can be recognized, but a loss is recognized if the fair value of the assets acquired is less than the carrying value of the assets given up. Okay, we're going to go through 3 examples from the text. Okay, I'm going to start a new video so I don't get cut off.